Well, looking at personal finance, property is an area that a lot of people get worked up about, particularly at certain stages of the interest rate cycle and the economic cycle. Now, you have a lot of options open when deciding to buy to let. And a property investment in South Africa, or to buy a property that you just want to sell a few years later. Now we've got Erwin Rode, who is CEO of Rode and Associates, and John Luce, household and property sector strategist at FNB, joining us for more. John, let's start with you. I remember a few years ago us chatting about the number of people who were buying properties not to live in. It was almost a craze for buying properties that it was assumed would give you a better return than any other investment a few years later. What happened to all those people? Well,
yeah, it depends on when in the boom they bought. David, when we started our FNB estate agent survey back in about 2004, it was estimated by the agents that about 30% of total buyers were actually buying to let. That number now is around about 7 or 8%. Now, what was happening when we started that survey is there was incredible capital growth. That was when house price inflation was at its peak in 2004, 2005. And I think the problem with residential property is you've got a large group of unsophisticated investors who actually look more at capital growth. Okay, you have speculators as well, riding that strong capital growth trend to make a very quick bucks, turn the property around quickly. But you've got the unseasoned buy-to-let investor as well, who doesn't even understand often what a yield is. And they look at recent capital growth and they extrapolate that into the future, and they think this is a winner. And so those, I think, who bought to let around about 2006, 2007, I think they lost out badly. Yields had been compressed by that stage, and then, of course, the capital growth stopped. So I think a lot of them came unstuck. Difficult to know how many, but that's the consequences of not understanding, perhaps the investment principles of looking at yield and not necessarily at capital growth alone.
You mentioned a lack of understanding there. Doesn't that just drive the emotional attachment that people have towards purchasing homes out of it? What trends have you seen with regard to that?
Look, even economists are now realizing slowly but surely that investors are not necessarily, or players in the economy are not necessarily rational. So what John was describing here was a classical bubble developing around the Braaivleis fire. And your neighbor has done very well, so you've got to jump in too, just of course as you reach the top of the cycle. But besides that, the property cycle, including the house price cycle, is a very long cycle. So it's difficult for a layman to know where we are in the cycle. The cycle, in fact, to give you a feel for it, is between 15 and 20 years long. So it means that in practice you've got about twice the opportunity in your working life to make a killing or to get bankrupt, bankrupt yourself.
When you think about it like that, you've got to think a lot more carefully, John. Sure. At the moment now, the last couple of times you've come in the studio, you've talked about house prices. There's been no substantial rise. They've been static or rising marginally, maybe up to in terms of the inflation. But there must be properties that to offer value. So how, if you're thinking of getting into property as an investment, buying a second home, buy to let, how should you be thinking now about this, and what are the factors?
Well, I think the first thing is understand what a yield is, and that's
tell us what a yield is.
It's the income stream, the expected. Well, not the yield is an actual income that you can earn off the property. In other words, the rental income relative to the value of the property. So as a percentage of the property, put simplistically. Now, there's a gross yield.
There's operating costs, if I may.
Yeah. There's a gross yield, and then you've got to net it out to take off operating costs as well. And you've got to decide. Now that's what you should be looking at. You should be buying an income stream more than looking at what you think capital growth may be. Capital growth is a bit of a bonus when it happens. And then I guess you've got to compare it with other yields. I mean, on a government long bond now, I think 10 years and longer, it's possibly somewhere over 8%, 8 to 9%, something like that. What are money market interest rates and so on? If your yields are very low, on certain residential property, you might just be better off putting it in the bank, hypothetically. So, I think that's probably the most important thing is to start thinking in terms of buying an income stream and not just riding some capital growth trend if and when it arises.
And if I could just, I know Gugu's got something here, but if I could just put in one more thing, don't assume interest rates are going to stay where they are.
And that is exactly it. There's a couple of things. There's municipal rates that are going up steadily or whatever. Can you offload that cost onto your tenant over time? But
not
yes,
to mention the cost of your banker, the interest rate he's going to charge you.
Sure, and exactly. I mean, you know, we're at 8.5% prime now, but these are abnormally low rates. The repo rate of 5% is below CPI inflation. I don't think the Reserve Bank wants to keep it there over the longer term. So these are the type of considerations one needs to consider.
And when it comes to purchasing that investment property, I mean, buying your own property for a residential property to live in entails a lot of red tape as well as regulations and paperwork involved in that. When it comes to a second property, are there any hidden costs or hidden paperwork that the consumers need to be aware of?
No, there's nothing hidden. It's the well-known operating cost of the insurance of the property, the rates and taxes, and the maintenance. Those are the three crucial
Perhaps
expenses.
not hidden, Erwin, but ignored by people going into this.
There
you
are
must be
few
pretty
risks.
amateurish when you ignore it, you know.
Yeah, I think that is important. Is, you know, if you look at TPN statistics.
What's TPN?
Tenant Profile Network. They keep record of tenants in good standing and those in arrears. And 84%, the most recent figures, if I remember, 84% are in good standing. That means that's fine, but it's a good number. I guess if you know, depends how you look at it. But 16% are not in good standing. So there is a risk there. You know, you can't just automatically assume that your tenant is going to pay. In certain cases, it doesn't happen. And then you've got to be up to speed with your legal rights, well, your legal obligations and your legal rights, and how to resolve the problem. And you know, I think that's also important, is to think of when you're buying a house to put a tenant into let, or any property to let, you're buying into a business. And you cannot just sit back and the money will roll in. It's not like running a restaurant where you have to be there till 10 every evening. But certainly there's a certain level of expertise, you know, legal aspects and so on that you have to be aware of, you have to understand properly. Otherwise you can come horribly unstuck.
I would like to come back to the question of capital growth, expected capital growth. Instead of what John said, that you shouldn't look at capital growth. In practice, I can guarantee you that 90%, if not more, of buyers out there buy as an investment looking forward to some capital growth. And that is the crucial assumption you make in your sums when you compare property as an investment compared to any other investment at the moment.
So to put it simply, it's the price that they think the house could be sold at in 5 years' time.
Correct. That is the crucial assumption, and that's where, in my mind, people get unstuck at the moment. They assume still fancy growth rates. They are saying to themselves, well, we've got a temporary interruption here in the growth rate, the capital growth rate of property. All will be nice again and right again in a year's time, so I'm buying now big time. Well, in fact, it's not happening big time, but those who still buy. Yeah. My point is that property prices in South Africa, house prices, are still very high in real terms, which means that the developers out there can still make a pretty nice profit when developing. The only risk factor at the moment is not the price level, but the assumed uptake level. Absorption level. In other words, am I going to sell 3 houses per month in this development or only 1? That is the crucial criterion or crucial factor in the maths.
Sounds like you need to spend several months doing some homework, checking the market and getting hold of experts like you to tell them what to do. Thanks to Erwin Roeder, who is Chief Executive of Roeder & Associates, and John Luce, the Household and Property Sector Strategist at FNB.